We all want to save money on our taxes, don't we? Good morning, happy Friday. Welcome to Sunrise Small Talk, episode number 21, 6:30 on the dot, Friday morning. Today we're going to talk about a concept called deduction clustering. When the Tax Cuts and Jobs Act took effect in 2018, one of the most significant changes was the increase in our standard deduction. The way this works, a quick recap, is we itemize our deductions: mortgage interest, charitable contributions, medical expenses. We itemize those, we stack those on top of each other, and then we look at our standard deduction, and we get to take whichever one is higher. We take that amount and reduce it from our gross income, and then we calculate our taxes due. So the standard deduction, after its significant increase, is pretty big, right? It is about $30,000 for a married couple over the age of 65. You get to tack on a little bit more if you're over 65. So let me give you an example of how deduction clustering works. Some of the things that we historically have always deducted would include our SALT taxes, state and local taxes. This is now capped at $10,000, but we can itemize that. We can itemize our mortgage interest. We can itemize our charitable contributions, right? That's one we're very accustomed to. And we can itemize medical expenses above and beyond 7.5% of AGI, or adjusted gross income. What does that mean? That means if your adjusted gross income is $100,000, any medical expenses above $7,500, you can itemize. This list is not inclusive of everything. These are just some of the most common examples. So what I'm going to do with the deduction clustering concept is I'm going to take all of these items and I am going to try to fit them all into one tax year. 2022 is behind us. Let's focus on 2023 because that's where we are right now. I am going to talk to my local government, figure out how I can pay my 2023 SALT taxes and my 2024 SALT taxes. So I'm going to pay the current year and prepay next year's. Same with my mortgage interest. I'm going to pay my mortgage interest for 2023 and try to get some of 2024's into this year. Charitable contributions. If we donate $5,000 or $10,000 every year in December, let's go ahead and double up on that. We're going to do 2 in December, one for 2023 and one for 2024. And my wife and I are both going to have those medical operations done, the ones that we've been putting off for years. So now we have significantly increased these itemized deductions for 2023. Now you can talk to the bank about prepaying interest or postponing interest and paying it the next year. That's something that you want to make sure that you do it the right way. But the point is, with deduction clustering, you want to get all of this crammed into one year, 2023 in my example. So then at the end of 2023, I've stacked on so many itemized deductions that now my itemized deduction number is significantly higher than that $30,000 standard deduction. There we go. I win the game. In 2022, I got a nice standard deduction. In 2023, I'm going to itemize and I'm going to get a huge deduction. And then in 2024, since I prepaid most things, we're going to go back to that standard, which is still a very favorable figure. So there you have it. Deduction clustering, just a little strategy to rearrange things. It's not costing you anymore. You're just rearranging your timing and saving money on taxes. So as always, feel free to share this. Happy Friday and have a great weekend. Take care.